Trying to understand U.S. crypto regulation. Honestly, it can feel like you're navigating a maze, blindfolded.
Yeah.
You take a step one way, bam, you bump into the SEC, try another path. Oh, there's the IRS, wanting their cut.
Right.
Then you hear whispers about the CFTC and these complex state rules, and the ground just feels like it's constantly shifting under your feet. New updates from Congress, the White House.
Yeah.
Why is it such a tangle?
It really is.
And what is all this recent news? These new bills, repealed rules, the court fights. What does it actually mean for you?
Yeah.
If you're holding crypto, trading it, maybe building in the space, or even just curious about digital assets in the U.S.?
That feeling of being lost in a maze, it's completely understandable. And that complexity, that feeling of dealing with all these separate, sometimes conflicting rules, it really stems directly from the fact that there isn't a single clear regulatory framework for crypto here in the U.S.
Right. No single rule book.
Exactly. As multiple sources we're looking at today highlight things. Thomson Reuters, Cointelegraph, different federal agencies see crypto through totally different lenses.
Like completely different perspective.
Completely. Is it a security? A commodity? Is it property? Or maybe even money? And because each agency views it differently, they each sort of assert their existing authority over certain parts of the crypto world.
Claiming their turf.
Pretty much. And this fragmentation, it's not just a headache for businesses trying to comply. It genuinely impacts everyone involved in the market. It can stifle innovation, definitely affects public trust.
That's exactly the challenge we're trying to tackle today. So our mission here in this deep dive is to take this stack of sources you've gathered, articles, legal stuff, IRS guidance, updates on laws and executive actions, and pull out the key insights, the stuff you really need to know. We want to cut through all that noise, map out who the main players are, what they think, understand the big changes happening right now, and just give you a clearer picture. Where do things stand? Where might they be going? Make that maze feel, well, a little less intimidating.
Think of us as your guides, yeah. We've got the map your sources, and we're here to point out the tricky turns, the important landmarks in this whole regulatory landscape.
Okay, let's start mapping then. Who are the main federal players? Why are there so many agencies involved, all wanting a piece of the action?
Well, it really boils down to the nature of crypto itself, Digital assets just don't fit neatly into the old boxes. The laws we have, they were written decades ago, long before Bitcoin was even a concept.
Right, trying to fit a square peg in a round hole.
Kind of. Is it like a stock? Or maybe like gold? Or dollars? Or is it something totally new? Because crypto can have characteristics of securities and commodities and currency and just digital property.
All at the same time, sometimes.
Exactly. So all these different regulatory bodies established way back when feel they have a reason, a mandate, to regulate some aspect of it based on their existing definitions and turf. That's the fundamental reason we have this multi-agency mess we see today. You see that covered in Cointelegraph, Thomson Reuters.
Applying old rules to brand new tech.
Yeah, that sounds like a recipe for confusion, all right. Okay, let's dive into the agencies. Starting with, well, probably the most talked about one lately when it comes to crypto, the SEC, the Securities and Exchange Commission. Their main view is that a lot of crypto tokens are what?
Securities. Plain and simple for them, often. The SEC's position, and they've been, let's say, aggressive in pursuing it through enforcement actions.
Very aggressive.
Very. Their stance is that many crypto tokens, especially those sold in initial coin offerings, ICOs, or offered on different platforms, are essentially being sold as investment contracts.
The magic words. Investment contracts. Precisely. And under U.S. law, investment contracts are securities. So their focus, as you see in sources like Thomson Reuters and Run Sensible, is squarely on these offerings they think meet that definition, and also the platforms, the exchanges that allow trading in them.
And the classic test they pull out to decide if something is an investment contract is the Howey test. Everyone in crypto knows Howey, but it came from a case that had absolutely nothing to do with crypto, right? Like oranges.
That's the one. It's almost legendary. The Howey test comes from a 1946 Supreme Court case. It involved selling interests in, yes, Florida orange groves.
Orange groves, okay.
The court came up with this test back then to figure out what counts as an investment contract under the Securities Act of 1933. And now the SEC applies this same four-part test to crypto. Let's break it down simply.
Yeah, let's do that. What are the four parts?
Okay, first, there has to be an investment of money. This is usually pretty easy to meet with crypto. Someone's spending real money, fiat, or even other crypto to get the asset.
Makes sense. Number two.
Second, the investment is in a common enterprise. This basically means your money is pooled with other investors, and everyone's fortunes are kind of tied together, usually linked to the success of the project's founders or the overall venture.
Okay, pooled money, shared fate. Got it. Third,
There's an expectation of profits. People aren't just buying the token to use it right away, necessarily. They're primarily buying it expecting that its value will go up, so they can sell it later for a profit.
the speculation aspect.
Largely, yes. And fourth, this one's crucial and often the most debated. The expected profits are derived solely from the efforts of others.
Ah, the efforts of others prong. That's the big one.
It really is. It
Yeah.
means you, the investor, aren't doing the work to make the profit. You're relying on the managers, the developers, the promoters, some third party to make the whole thing successful and drive up the token's value.
So if you've got a crypto project where people put in money, hoping the team behind it builds something awesome so the token price moons, the SEC is probably going to look at that and say, yeah, that looks like an investment contract to us.
That's the logic, exactly.
And they haven't held back using that logic. We've seen them target some huge names in the crypto world.
Oh, absolutely. The sources really hammer this point home, the SEC's aggressive enforcement strategy. They've launched major lawsuits against big platforms like Coinbase, Binance, Kraken,
Yeah, the big ones.
the biggest, alleging that these exchanges are listing tokens the SEC considers unregistered securities, and that the exchanges themselves are operating illegally as unregistered exchanges or brokers. It shows the SEC is really leaning hard on existing securities laws, applying Howey to stake its claim. Thomson Reuters, Run Sensible, they detail these actions.
Like, here's where it gets really interesting and kind of shows how hard it is to apply this old test to new tech. Even the courts can't seem to agree when they apply Howey to crypto. There's this big split in judicial opinions people talk about.
Yes. This disagreement among judges is critical. It adds so much uncertainty. We saw a perfect example in the SEC's case against Ripple Labs over the XRP token.
Right, the Ripple case. Huge news.
Huge. Judge Annalisa Torres, back in July 2023, she ruled that Ripple's programmatic sales of XRP, the ones on exchanges to regular retail buyers, did not count as securities transactions under Howey.
Why not?
Her reasoning was largely that those retail buyers wouldn't necessarily know their purchase was directly funding Ripple's efforts or relying on them in the same way an institutional buyer might. But importantly, she did find that Ripple's direct sales of XRP to big institutional investors were securities sales.
Wow. So the same token, XRP, could be a security or not, depending on who bought it and how it was sold. According to that one judge, anyway.
According to Judge Torres, yes. It created this distinction based on the sales method and the buyer type.
Okay, so what happened in the other big case that contradicted this?
Well, fast forward just a few days later, still July 2023, the SEC's case against Terraform Labs and Do Kwon, remember Terra Luna?
Oh, yeah. Big collapse.
Right. Well, Judge Jed Rakoff in that case explicitly disagreed with Judge Torres's distinction about programmatic sales. He ruled that Terraform's tokens, UST and LNA, were securities. Period.
So no distinction for him.
Nope. He basically said the Howey test applies to the offering itself, the nature of the asset, and how it was presented, not necessarily whether every single buyer knew who the promoter was or how they bought it. This direct clash between two federal judges applying the same test to similar assets, it just highlights the massive lack of legal clarity.
That's incredible. Same law, similar assets, opposite conclusions from judges.
Exactly. As Thomson Reuters and Run Sensible point out, it means the outcome of your case could literally depend on which courtroom you end up in. That adds a huge layer of unpredictability for the whole industry.
It really underscores the need for clearer rules, doesn't it? Now let's talk about something super recent from the SEC itself. April 14th, 2025. A statement from their Division of Corporation Finance. What was that about?
Right. This statement, which the National Law Review covered it, wasn't the big classification guidance everyone's hoping for.
Okay. Not the Holy Grail then.
Not quite. Instead, it focused on disclosure requirements under existing securities laws. Basically, the division shared some observations. They were talking about how companies that do issue crypto assets that are considered securities or whose activities involve investment contracts, how those companies should think about their disclosure duties. when they register with the SEC or file regular reports.
So it's more like, okay, if you fall under our rules because your token is a security, here's how you need to tell the public about the risks in your business, but not here's the magic formula to figure out if your token is a security.
You nailed it. It provides some, let's say, incremental clarity on reporting for those already caught by securities law. It talks about applying existing frameworks to crypto risk factors, business descriptions, financial statements for crypto stuff. But importantly, the statement did also acknowledge that some digital assets might fall completely outside the definition of a security, and therefore outside the SEC's jurisdiction.
Oh, interesting. They actually said that.
They did acknowledge it, which is something. But while it admits not all crypto is a security in their view, it still doesn't give issuers or the public a clear test or pathway to figure out which assets fall into that outside category. So yeah, helpful for maybe a small group already dealing with SEC registration, but it doesn't solve the fundamental Howey classification puzzle for most folks.
Incremental indeed. Sounds like the SEC's trying to give guidance where they feel they legally can under current law, but they're stopping short of that really fundamental clarity the industry keeps asking for on classification. Okay, let's shift gears. Moving on from the SEC's securities focus, the other big federal player, the CFTC, they see crypto primarily as
commodities. The Commodity Futures Trading Commission. Their main job is regulating derivatives, markets, futures, options, swaps based on underlying assets. And their view, which courts have generally supported, is that certain major digital assets, especially Bitcoin and Ether, act more like traditional commodities.
like gold or oil or wheat.
Exactly. Things that are basically economic goods, tangible, or in this case, intangible, that can be bought and sold, especially in the spot market. That's their lens, generally speaking. Sources like Thomson Reuters and Cointelegraph outline this view.
And their approach to the actual spot market, just buying and selling Bitcoin, for example, that's been a bit different from the SEC's approach traditionally.
Generally, yeah. Historically, the CFTC has been seen as taking a bit more of a hands-off or perhaps less aggressive stance towards regulating the spot trading of crypto compared to the SEC's intense focus on whether the asset itself is a security.
But they are very active in the derivative space.
Oh, absolutely. That's their core jurisdiction. They are very active in regulating futures contracts, options, swaps based on crypto. If you're trading crypto derivatives, you're squarely in the CFTC's world.
And they've brought enforcement cases there too, right?
Definitely. The CFTC has gone after platforms and individuals for running unregistered derivatives exchanges or for fraud and manipulation in the crypto derivatives markets. Sources mention actions against big names like Uniswap, Binance, Celsius, UKI-DAO, and they got a huge judgment against FTX and Sam Bankman-Fried related to fraud involving derivatives. So they are definitely policing that area.
Okay, so SEC fighting over spot market classification as securities, CFTC policing the derivatives built on top. It's like two different layers. Now, there's also this idea floating around that a crypto token isn't necessarily stuck in one category forever, that it might transform.
Yeah, that idea gets discussed. Cointelegraph mentions it. The concept is maybe a token starts out looking a lot like a security, especially during fundraising, right? Investors are clearly banking on the core team to build the network and make the token valuable.
Relying on the efforts of others.
Exactly. But maybe as the project matures, if the network becomes truly decentralized and the token's main use shifts away from pure speculation towards actual utility within that working decentralized system.
Like paying for gas fees or governance.
Right. Then, arguably, it could transition. It might start looking more like a commodity or just a medium of exchange, and that could potentially move it out of the SEC's securities bucket and maybe more into the CFTC's commodity space, or even just under FinCEN's view as money.
That transforming token idea? Wow, that adds another whole layer of complexity. It's not just what it is, but when and how it's being used and governed. Fascinating idea, but it sounds like regulators and courts are still figuring that one out.
Very much still being debated.
Okay, enough securities and commodities for a second. Let's switch to the agency that hits everyone's wallet.
Yeah.
The IRS. How do they look at crypto, and what does it mean for us taxpayers?
Okay, the IRS. Critically, they've had a consistent view since way back in 2014. For federal income tax purposes, they treat virtual currency, including crypto, as property.
Property, not currency, not a security. Property.
Correct. Just like stocks, bonds, real estate, collectibles. It's property in their eyes.
Yeah.
This is fundamental for taxes. You see this in the IRS, FAQs, Gordon Law analysis, Cointelegraph. They all confirm this.
Property. Okay, so what's the biggest, most important consequence of that property label for someone who owns or uses crypto?
The absolute number one consequence is this. Almost every time you get rid of crypto, it's potentially a taxable event.
Every time. Like,
Pretty much. If you sell it for cash, if you trade it for a different crypto, even if you use it to buy something, goods or services, the IRS views that as selling property. And that sale can trigger a capital gain or a capital loss that you have to figure out and report on your taxes.
whoa, hang on. So if I use, say, Bitcoin to buy a coffee, that's a taxable event. I have to calculate capital gains on my coffee purchase.
Under the IRS's rules, yes, technically. You're treated as having sold the Bitcoin for its fair market value in dollars at that exact moment. You realize a gain or loss on that tiny amount of Bitcoin, then you're seen as using those proceeds to buy the coffee.
That sounds incredibly cumbersome.
It is, which is why meticulous record keeping becomes absolutely essential, even for small transactions. And similarly, trading one crypto for another, say, swapping some Bitcoin for Ether, that's also taxable.
Right, that's a big point of confusion for people. Swapping crypto to crypto is taxed.
Yes. You're treated as selling the Bitcoin for its dollar value, realizing a gain or loss, and then immediately using those dollars to buy the Ether. The disposal of the Bitcoin is the taxable event.
Okay, so disposing of crypto is key for capital gains or losses. What about when crypto is treated as just regular income, ordinary income?
That happens primarily when you receive crypto as payment. If you get paid for work in crypto, either as an employee or a freelancer, that's ordinary income. Also, if you earn crypto through things like mining or staking rewards or getting airdrops or earning interest or yield on your crypto holdings, that's all generally ordinary income too.
And how do you figure out the income amount then? Is it the value when you sell it?
No, critically, it's the value when you receive it. The amount you report as ordinary income is the fair market value of the crypto in US dollars at the exact date and time you received it and could actually control it. The IRS says for blockchain transactions, that's usually when it's recorded on the ledger.
Okay, so if I get like 0.01 ETH from staking, I need to know the dollar price of 0.01 ETH right that moment it hits my wallet and report that dollar amount as income.
Precisely. That dollar amount is your ordinary income for that transaction.
Got it. Understanding that difference capital gains from disposing versus ordinary income from receiving seems absolutely vital. Okay, let's break down how you actually calculate the capital gain or loss when you do dispose of crypto.
Okay, the basic formula is simple enough on the surface. Your capital gain or loss is your sales proceeds minus your cost basis.
Sales proceeds minus cost basis. Okay, sales proceeds seems straightforward enough is what you got for it.
Yeah, basically. It's the fair market value in US dollars of whatever you received when you sold or exchanged the crypto. That could be actual dollars, or the value of the other crypto you got, or the value of the goods or services you bought with it.
Okay, now cost basis. That sounds like where the real headache starts.
That's usually where the tricky part is, yes. Your cost basis is generally what you originally paid for that specific crypto in US dollars when you first got it.
Including fees.
Yes. Importantly, it includes the purchase price plus any transaction fees or commissions you paid to acquire it. You need to track that total cost.
Okay, what if I didn't buy it? What if I earned it as income, like from staking?
Good question. If you received the crypto as ordinary income, like from mining or staking, and you reported that income correctly at the time, then the dollar amount you reported as income becomes your cost basis for that crypto when you later sell it.
Ah, okay. So the income amount becomes the starting point for calculating gain-loss later. What about gifts?
Gifts have more complicated rules, often involving the donor's original basis, but the key takeaway is you always need to track how you acquired the crypto and what its value was, or what your basis is derived from at that time. Records are everything.
So meticulous records of every single acquisition date, time, cost in USD, fees. It's absolutely non-negotiable for figuring out your basis later on.
Non-negotiable.
And then how long you hold it makes a big difference in the tax rate, right?
Right.
Short-term versus long-term.
A huge difference. This is critical. If you hold the crypto for 1 year or less before you sell or exchange it, any profit is a short-term capital gain
And short-term gains are taxed.
at your regular, ordinary income tax rates, which can be pretty high, 10%, 20%, all the way up to 37%, depending on your overall income bracket.
Ouch. Okay, what if you hold it longer?
If you hold the crypto for more than 1 year before selling or exchanging, any profit is a long-term capital gain, and long-term gains get preferential treatment. They're taxed at much lower rates, 0%, 15%, or 20% again, depending on your total taxable income.
Wow, that's a massive potential difference. Holding for just over a year could literally cut your tax bill on the gains by more than half in some cases.
It's a major incentive baked into the tax code for longer-term investing versus rapid trading, purely from a tax standpoint.
Definitely something for people to keep in mind. Now, another layer of complexity. What if you bought, say, Bitcoin multiple times at different prices, different dates? How does the IRS know which Bitcoin you sold when you decide to sell some?
Ah, yes, the accounting method question. This is where specific identification, or FIFO, comes into play.
Specific ID or FIFO? Explain those.
Okay. The IRS does allow you to specifically identify the exact units of crypto you're selling. But, and this is a big but, you need incredibly detailed records. You need to prove the date, time, and cost basis for those specific units you claim to be selling. Maybe linking them to unique transaction IDs or something, if possible. It's a high bar for record keeping.
Okay, so specific ID is possible, but requires serious tracking. What if you don't have that level of detail? What's the default?
If you can't specifically identify, the default method the IRS requires is FIFO first in, first out.
First in, first out, meaning?
Meaning the IRS assumes you sold the oldest units of that crypto first. The very first ones you ever acquired are deemed to be the first ones out the door when you sell.
So unless you're super organized,
Yeah.
the IRS assumes you sold the ones you bought longest ago, which probably have the lowest cost basis, meaning potentially higher capital gains reported.
That's generally the result, yes. FIFO can often lead to recognizing larger gains sooner compared to if you could specifically pick higher cost basis units to sell first. It's kind of designed to favor the IRS if your records aren't perfect.
Okay, that makes sense. Now, one source, Gordon Law, mentioned something about wallet-by-wallet accounting being needed for 2025 taxes. What's that about? Does that add another wrinkle?
Yeah, that detail suggests things might be getting even more granular. While FIFO, or specific ID, tells you which units from your total pool of, say, Bitcoin you sold, wallet by wallet, tracking implies you might need to trace the cost basis of assets as they move between different wallets or exchange accounts you control.
Even though moving between my own wallets isn't taxed itself?
Right, the transfer itself isn't taxable. But this wallet-by-wallet idea suggests that for reporting purposes, especially perhaps for the new 1099 DA forms brokers will issue, you'll need a clear audit trail showing the basis of the crypto associated with specific locations or wallets. It makes tracking transfers between your own accounts a crucial step for maintaining accurate basis records for different pools of assets.
More complexity.
It really highlights how important good tracking software or very diligent manual records are becoming. It's not simple stuff.
Yeah, definitely not. Okay, let's just hammer home the basics again. Based on the IRS guidance, what are the most common things that are taxable and what generally isn't?
Good idea. Let's make it super clear. Based on IRS, FAQs, and sources like Gordon Law, clearly taxable events, selling crypto for dollars or any fiat, swapping one crypto for another, yes, even crypto to stablecoin swaps, using crypto to buy stuff, goods, or services, trading crypto for NFTs, getting crypto from mining, getting staking rewards or yield, receiving airdropped crypto, getting paid your salary or freelance fees in crypto, earning interest on crypto. Basically, any disposal or income receipt.
Okay, that's a long list of taxable things. What about non-taxable?
Generally non-taxable events. Just buying crypto with dollars, transferring crypto between wallets or accounts that you own, but remember, you still have to track the basis. Just holding crypto, even if the price skyrockets, it's an unrealized gain, not taxed until you sell or dispose. Giving crypto as a genuine gift, within limits usually. Donating crypto to a qualified charity.
That distinction is so important. Holding is fine. Transferring between your own accounts is fine for tax liability, but you still need to track it for basis. The taxable event is usually getting rid of it or getting it as income.
Precisely. And I can't stress this enough. You are legally required to report all your taxable crypto activity. Doesn't matter how small the amount, doesn't matter if you got a tax form from the exchange or not. The burden is on you, the taxpayer, to keep records and report accurately.
And reporting losses is important too, right?
Absolutely. Don't forget losses that can offset your capital gains and potentially even some of your ordinary income, which can lower your overall tax bill. So track and report everything: gains, losses, income.
Okay, let's talk about those tax forms, because this is where things are really shifting starting next year. For activity in 2025, reported in 2026, the big news. Form 1099-DA.
This is a game changer for crypto tax reporting in the U.S. Starting with transactions in calendar year 2025, entities the IRS defines as brokers. This will definitely include the big U.S.-based centralized crypto exchanges. Maybe others, they will be required to track your gross proceeds from selling or exchanging digital assets. And they have to report this information directly to the IRS and to you on this brand new form, Form 1099-DA. It's specifically designed for digital assets.
Wow. So this is like how stockbrokers send out 1099-B forms now. The IRS is going to get automated reports on tons of crypto sales and exchanges.
Exactly like that. It means the IRS will suddenly have visibility into potentially millions, maybe billions, of crypto transactions that they never had easy access to before. They can just match the 1099-DA from the exchange against what you report on your tax return.
That makes accurate personal records even more critical than ever. If the exchange reports one thing and you report something different,
you'll likely get a letter from the IRS asking why. It massively increases the importance of getting your own reporting right. Huge increase in transparency and enforcement power for the IRS.
Now, tied into this reporting stuff, there was another big piece of news just recently, June 7th, 2025. Something about a specific rule being repealed.
Yes, this was an action by the executive branch. President Trump actually eliminated the IRS's controversial DeFi broker rule. The National Law Review reported on this.
The DeFi broker rule. What was that, and what does getting rid of it actually do?
Okay, so this rule, it was finalized near the end of the previous administration. The idea was to apply broker reporting requirements, kind of like the 1099-DA stuff, but specifically targeting entities involved in decentralized finance, or DeFi, maybe even the protocols themselves.
Targeting DeFi protocols to act like brokers. How would that even work?
Well, that was exactly the criticism. The crypto industry, especially the DeFi sector, pushed back hard. They argued it was technically impossible, or at least completely impractical, for a truly decentralized protocol, which often has no central company running it, to collect user ID info and report transactions like a traditional stockbroker or a centralized exchange does.
So the repeal action specifically killed that requirement for DeFi platforms to collect and report user data to the IRS.
That's the key takeaway. The repeal removes that specific reporting burden that many feared would cripple DeFi in the U.S. However, and this is really important, it does not change your tax obligations as an individual.
Yeah. So I still have to report my DeFi gains and income.
Absolutely. You still owe taxes on your DeFi activity, just like activity on Coinbase or anywhere else. And critically, the repeal does not affect the requirement for centralized exchanges and other defined brokers to start issuing the new Form 1099-DA for 2025 transactions. That's still happening.
Okay, that's a crucial clarification. Repealing the DeFi rule is about who reports to the IRS, taking that burden off DeFi protocols. But it doesn't change your taxes, and it doesn't stop Coinbase or Kraken from sending that 1099-DA next year.
Exactly right. It's a targeted repeal of a very controversial part of the planned reporting system. But the broader trend of increased reporting by centralized players is definitely moving forward. And as sources like Gordon Law are warning with the 1099-DA coming online, the IRS is signaling they're ramping up enforcement. They'll have much better data to find people who aren't reporting correctly. So now is definitely the time to get your crypto tax house in order, maybe even look back at past years if you haven't been reporting fully.
A very clear warning shot from the IRS, essentially.
Yeah.
Okay, beyond the big three, SEC, CFTC, IRS, who else is in this regulatory mix at the federal level?
There are several others with important specific roles. You've got FinCEN, the Financial Crimes Enforcement Network. Their focus is anti-money laundering, AML, and combating terrorist financing. They see crypto as money and regulate crypto exchanges, some wallet providers, anyone transmitting virtual currency as money services businesses, or MSBs.
Which means KYC rules.
Exactly. MSBs have to follow AML KYC rules. Know your customer. That means verifying user identities, monitoring transactions, reporting suspicious activity. That's FinCEN's lane.
Okay. Who else?
Then there's OFAC, the Office of Foreign Assets Control. They handle U.S. economic sanctions. For them, crypto is just like dollars when it comes to sanctions. They publish lists of sanctioned people and entities, and importantly, they blacklist associated crypto wallet addresses.
So you cannot transact with those wallets.
Correct. It's prohibited. Engaging with those OFAC-listed addresses is a violation of sanctions. And then you have the FRB, the Federal Reserve Board. The Fed, they're the central bank, and they supervise traditional banks. They aren't directly regulating crypto for you and me, but they issue guidance on how banks, under their supervision, can engage with crypto, stablecoins, potential CBDCs. Banks usually need to give the Fed a heads up before jumping into new crypto activities.
So FinCEN for money laundering, OFAC for sanctions, the Fed for banks. They each have their own angle based on their core mission.
Precisely.
And if the federal level wasn't complicated enough, there's the states too, right? Adding another layer.
Oh, absolutely. State-level regulation is a huge piece of the puzzle and a major challenge, especially for businesses trying to operate across the country. The rules vary significantly from state to state.
How so? Like what kind of rules?
A big one is money transmitter licensing. If you're a business that moves crypto for customers, the rules for getting a license in, say, New York are very different from Texas or California or Florida. It creates this complex, expensive patchwork quilt of regulations that companies have to navigate. It really drives up compliance costs.
Can you give examples of states with notably different approaches?
Sure. Sources mention California, through its DFPI, is trying to build a more comprehensive licensing framework. Some see it as relatively clear, maybe even progressive, trying to create specific rules for the crypto industry.
Okay, California trying to build something specific. What about elsewhere?
Then you look at New York. The New York State Attorney General, the NYAG, has historically been very active, very assertive. They've launched numerous investigations, filed charges against crypto firms using existing state laws, often focusing on investor protection, fraud, or misrepresentation claims. It's seen as a tough environment by many. So you have this wide spectrum across the states.
Wow. Federal maze plus 50 state mazes. Okay, we've mapped the agencies, federal and state, their different views. Now let's circle back to Congress, because they're trying to step in, right? Trying to bring some order to this chaos with actual legislation. There's this new bill, the Clarity Act.
Yes, the Digital Asset Market Clarity Act, introduced in the House just recently, May 29th, 2025. Decrypt covered this. It's the latest big legislative push to try and create a clearer market structure for crypto in the U.S.
And what's its main goal? What's it trying to do?
The core objective is pretty straightforward. It wants to formally change existing securities laws to basically say that most crypto assets are not securities under the SEC's definition.
Okay, so taking them out of the SEC's box, where would it put them instead?
It aims to put most of them squarely under the CFTC's jurisdiction, classifying them as digital commodities.
Ah, so this is Congress trying to legislate an answer to that SEC versus CFTC fight. Essentially saying, okay, folks, we've decided most crypto is a commodity. CFTC, you're in charge of the spot market.
That's precisely the idea behind it. It's a direct attempt to move away from the current situation where the SEC keeps trying to apply the Howey test and regulate everything as a security, and instead create a framework where most digital assets are treated like commodities, regulated by the CFTC. Proponents argue this would finally bring the legal certainty the market desperately needs, resolving the agency conflicts and the mess caused by conflicting court rulings.
Where is this Clarity Act in the whole lawmaking process?
According to Decrypt, it was scheduled for a markup in the House Financial Services Committee on June 10th. That's a key step. The committee debates, maybe makes changes, and decides whether to send it forward for a full House vote.
Does the bill itself have any, special categories or nuances, or is it just everything's a commodity now?
It does have an interesting nuance. It introduces this idea of a mature blockchain system.
Mature blockchain system. What does that mean?
Well, an issuer could try to meet certain criteria for their network. Things like being open source, being functionally decentralized, meaning control is automated or distributed, and having no single entity owning more than, say, 20% of the asset.
And if you meet those criteria, what do you get?
The idea is maybe some slightly different regulatory treatment, some kind of benefit. But interestingly, the Decrypt article noted some industry skepticism about this. People saying the benefits of achieving this maturity status seem marginal, and that maturity doesn't get you much compared to just getting classified as a digital commodity in the first place under the bill.
Huh. So the main prize is the commodity classification, and this extra mature label might be more trouble than it's worth.
That seems to be the concern from some corners. It shows that even when trying to write clear laws, details can get complicated or controversial.
And this Clarity Act, it sounds a lot like another big crypto bill we heard about, the FIT 21 Act, which actually passed the House already.
They're definitely singing from the same hymn sheet, yes. FIT 21, the Financial Innovation and Technology for the 21st Century Act, which did pass the House, also came to clarify things by giving the CFTC the lead role for spot markets for assets deemed digital commodities. It still left room for the SEC to regulate things that genuinely function as investment contracts.
So Clarity is maybe a follow-up or a refinement, pushing that same core idea.
Yeah.
make the CFTC the main regulator for most crypto.
It certainly looks that way. Together, FIT21 and Clarity show a real concerted push, at least from the House side of Congress, to create a law that ends the current agency turf war and provides a clearer answer on classification, moving away from the SEC dominant approach for most assets.
So the legislative wheels are definitely turning, trying to impose some order. Now, we focused heavily on the U.S., but crypto's global, right? How does all this U.S. stuff fit into what's happening internationally?
That's a crucial point. The U.S. doesn't operate in a vacuum here. Crypto flows globally. There are international bodies working on standards. The most prominent is probably the Financial Action Task Force, FATF. They set global standards for AML-CFT, anti-money laundering, and counter-terrorist financing. FinCEN's rules in the U.S. are largely based on FATF guidance.
Okay, so FATF are global AML standards. What about actual regulation in other countries?
It's a real mix out there. The European Union, for instance, has adopted MiCA markets and crypto assets regulation. That's a huge deal, a comprehensive framework trying to create consistent licensing and rules across all EU member states.
A unified approach, unlike the U.S.
Right. Japan has had a relatively clear framework for exchanges for a while now. And then you have the other extreme, like China, which has effectively banned most crypto trading and mining activities. So U.S. regulators and lawmakers are also looking over their shoulders, seeing how these different approaches play out elsewhere.
Makes sense. Okay, we've covered a ton of ground. The agencies, their views, the tax nightmares, state rules, Congress trying to step in, the global context. Let's bring it all back home. How does this incredibly complex, fragmented, constantly changing regulatory picture actually impact you, the listener, depending on how you're involved with crypto?
It hits different people in different ways, but the impact is definitely widespread. Let's start with crypto exchanges and platforms. For them, it's a massive compliance burden, huge risk. They're constantly looking over their shoulder for the SEC, worried about listing tokens that might be deemed unregistered securities. They have to implement heavy-duty AML KYC under FinCEN. And now, starting 2025, they've got the huge operational lift of tracking and issuing those 1099 DA forms for all their U.S. customers. The classification uncertainty makes every business decision risky.
Sounds stressful. What about for regular investors and traders?
For individual investors and traders, the number one impact is taxes. You just have to understand what's taxable: selling, swapping, spending, earning. And you must keep meticulous records of every single transaction, every buy, sell, swap, reward, track the date, time, USD value, fees, calculate your cost basis accurately, report your gains and losses. And with the 1099 DA coming, the IRS is going to know a lot more about your activity on exchanges, so getting it right on your end is more important than ever.
Record keeping, record keeping, record keeping.
That's the mantra. Now, if you're involved in mining, staking, getting airdrops, or earning yield, you need to know that's generally ordinary income. Taxable based on the dollar value the moment you get control of the crypto. Report it as income.
Yeah.
For developers and crypto projects, the shadow looming over them is the Howey test. From day one, they have to worry. Could our token be seen as a security by the SEC? That massively impacts how they can raise funds, how they distribute tokens, how they structure their project to operate legally in the U.S. It's a huge consideration.
And even traditional banks.
Even traditional banks aren't immune. They're slowly dipping their toes into crypto services, but they have to navigate guidance from the Fed, the OCC. They need rock-solid AML KYC for any crypto activity, and they have to manage the risks, regulatory and reputational, that come with this new volatile asset class.
So yeah, this complexity isn't just theoretical. It creates real costs, real risks, real burdens for literally everyone touching crypto in the U.S. You can see how some sources say this uncertainty could chill innovation, maybe push some projects or activity overseas.
That's the core tension, isn't it? Regulators want to protect investors, prevent crime. But if the rules are too confusing or too restrictive or just unclear, it makes it really hard for legitimate innovation to flourish domestically.
Looking ahead then, what should we expect? Is it going to get clearer or just more complicated with more rules?
Probably both. It's likely we'll see a mix. There's definitely a trend towards more scrutiny, more compliance burdens. We should get some clarity from ongoing court cases. You know, the Supreme Court looking at crypto arbitration issues with Coinbase, the final outcomes and appeals in the Ripple case. Those will continue to shape how old laws apply to new tech.
So courts will provide some answers eventually.
Hopefully. And the SEC is signaling more rules might be coming too. Maybe expanding who counts as an exchange, which could pull in more platforms, rules about how investment advisors handle crypto custody. More regulation seems likely, even if it brings more clarity alongside the compliance headaches.
And the legislative efforts, like Clarity and 5021.
That's the other big track to watch. Those bills represent a serious attempt by Congress to impose a different structure, a clearer framework, to shift power towards the CFTC for most assets, away from the SEC's securities focus. Whether they can actually get through both the House and the Senate and become law, that's the big question mark, especially with political divisions. But the push for a legislative solution is very real.
And banks will probably keep slowly getting involved too.
Yeah, the trend seems to be slow, cautious integration by traditional finance, trying to operate within whatever regulatory lines exist or are being drawn.
Okay. Wow, that was a lot. A truly deep dive into a massively complex topic. Let's try and boil it down. What are the absolute key takeaways for our listener?
Okay, the essentials. U.S. crypto regulation. It's a multi-agency affair. SEC sees securities, CFTC sees commodities, IRS taxes it as property, FinCEN treats it as money for AML. They often have different views, sometimes overlapping authority, no single boss.
Got it. Multiple agencies, different lenses. What else?
Taxes are non-negotiable. You must track and report. And it's changing significantly. Centralized exchanges will start sending Form 1099-DA to the IRS for your 2025 activity. That's happening, even though that specific controversial DeFi broker reporting rule got repealed recently.
Okay, tax reporting is key in getting more transparency. And Congress.
Congress is actively trying to step in. Bills like the Clarity Act aim to create a clearer structure, probably making the CFTC the main regulator for most crypto, moving away from the SEC's approach. And all this is happening while major court cases continue to grind along, setting precedents.
So the main actions for anyone listening.
Yeah.
Stay informed. Understand how the rules apply to you. And I'm going to say it again, meticulously track your transactions, especially for taxes. The ground is constantly shifting.
Diligence and awareness are absolutely key to navigating this space right now.
All right, final thought then. We've got this clear tension, right? Different powerful agencies seeing crypto fundamentally differently. We have Congress actively pushing for potentially a whole new structure. We have these major real-world changes happening in tax reporting that will impact millions. It really makes you wonder, how long can this fragmented, sometimes contradictory regulatory approach actually hold up in the U.S.? What's it going to take to finally force a more unified, coherent vision?
Right.
Will it be a landmark Supreme Court decision? Will one of these big bills actually make it into law against the odds? Or will it take some other major market event, maybe another crisis, to finally knock heads together and demand a single clear path forward for crypto regulation in America? It feels like something has to give eventually.
That is the multi-billion-dollar question, isn't it? And one we'll definitely keep watching.
Well, that wraps up our deep dive into the complex world of U.S. crypto regulation. Thank you so much for joining us as we tried to make sense of this maze.
My pleasure. Thanks for having me.
We really encourage you to keep exploring these topics, stay curious, and stay informed. Thanks for listening.